seen someone talk about a new 40-20-20 portfolio, 40% stock, 20% bonds, 20% gold. That would be huge. We're not there yet, but I think sovereign wealth funds, central banks are showing the way. And that's why JP Morgan talked about the $6,000 gold by 2029. It could be before 2029. Monday, May 12th, 2025, Maneco 64, home of alternative economics and contrarian views. Well, a lot of talk about a trade deal. I'm not too sure if it is a deal yet, but what I want to talk about today, while the world is distracted by China, US trade deals, and other topics, is the bond market. I think long-term treasuries are losing the war to gold, and that's very important. And that's what we're going to look at today. And on Saturday, I made a video about dollar hegemony in meltdown mode. And I spoke about an article on Bloomberg where they talk about how Asian financial centers are trying to move away from the dollar. They're using yuan, they're using the euro, they're using gold more for transactions. And I saw another article this weekend in the FT talking about the same kind of stuff, that more and more people are moving away from the dollar. And by that, I don't mean the retail investor. I mean big sovereign wealth funds, big institutional investors, and even JP Morgan announced on May 7th, there's an article here on Reuters that says JP Morgan sees gold prices at $6,000 by 2029 if foreign US asset holders shift to gold. Well, I've been saying that for years, that once the petrodollar and the dollar loses its importance in terms of a major reserve asset, the only real reserve asset that's credible, well, it is the most credible, of course, is gold. And don't forget, these bullion banks like JP Morgan, they're always very conservative about the gold price. That's all I will say. And aside from the US bond market, the long-term treasuries, we're going to look at the JGBs today. They're starting to show some signs that there could be trouble ahead. So let's look at the announcement that Besant made yesterday out of Geneva. I assume he was still in Geneva yesterday when he released this 11th of May. It says that the headline on the White House memo is U.S. announces China trade deal in Geneva. But I guess a lot of people are going to see this and they're going to assume, oh, it's a trade deal. They're not going to read the whole thing. But I've read the whole thing. I mean, I'm going to read it to you and you make up your mind of whether there is a trade deal. And of course, we're going to look at the market reaction to it right now. Of course, the market's only open officially at 9:30 New York time, but they're trading in the futures exchanges. So it says, and this is Besant saying this, I'm happy to report that we made substantial progress between the United States and China in the very important trade talks. And then he goes on to thank the Swiss hosts, right, which isn't really that important. And he says, we had the vice premier, 2 vice ministers who were integrally involved, Ambassador Jameson and myself, and I spoke to President Trump, as did Ambassador Jameson, and so on and so on. And then he says, so there will be a complete briefing tomorrow morning. And I think it's come out that he's going to be on at 7 a.m. Eastern time, so quite early, before the markets open, 2.5 hours before. I haven't seen any announcement from the Chinese. So what I wanted to say is this really a trade deal? Some people have noted that it should have been Trade Representative Navarro and also Commerce Secretary Lotnick that should have gone to Geneva if it was a trade deal. Could this be another kind of deal, maybe to do with having China support the U.S. Treasury market, and I doubt they will do that. And as I speak here, and it's 6:35 a.m. London time, the 10-year yield is up 4 basis points at 4.42. Keep an eye on the 4.33 level. That's a really important level. If we don't get back below that level, it's a negative situation, I think, for the bond market. And I've noticed that Japanese yields are not behaving very well. The 10-year yield is up substantially. It's almost at 140. Just show you this chart of the JGB 10-year yield. Yes, it took a big drop in the beginning of April and then rebounded. It looked like it was going to drop again. It looked like a bear flag, which is positive for bonds, negative for yields. But now it's rebounding back again. It's broken this bear flag. And why is this important? Well, because of the yen carry trade. For decades, really, the Western financial markets have been financing their speculative liquidity activities by borrowing yen. But now, if Japanese government debt yield starts rising, Japanese investors, they're gonna come home and sell their treasuries and start investing in JGBs because there's a higher yield. Up until a couple of years ago, the yield on this 10-year was like zero, sometimes even negative. And there are a lot of hedge funds and speculators in the West who have been borrowing in yen to, take those proceeds into dollars, put it into dollars and buy high yielding assets in the West. But as the cost of borrowing in yen rises, they're going to have to unwind those carry trades, and they're going to lose a lot of money. They're going to have to sell a lot of their assets. So keep an eye on that. So I think there's trouble ahead for the financial markets, again, stock markets and bond markets. And there's another reason for it. It's the fundamentals. I just saw there's an article or some kind of research that Morgan Stanley put through to their clients, and I got it courtesy of Zero Hedge. It says Morgan Stanley reveals the ugly truth about the 2026 budget deficit. That's the other thing we need to focus on. I think there's $6 trillion to be rolled over in treasuries before the end of the fiscal year. Morgan Stanley talks about the fact that the deficit for 2026 fiscal year is going to be about 7% of GDP. It's already about 7% this fiscal 2025. And that's taking like ideal conditions, right? It's not taking a recession into consideration. If there is a recession, I can see this going up to 10-12% of GDP or even more. And that's when the Fed will have to step in, of course, and print like crazy. So, yes, there's a lot of euphoria, it seems, but actually the markets are not up that much compared to a few weeks ago when Trump backed down from his reciprocal tariffs, right? The 90-day, I think it was a 90-day postponement or grace period. I think the Dow was up over 1,000 points. Yeah, it was really euphoric, the markets. Right now, actually, the Dow futures is only up 460, just over 1%. The S&P 500, that's up 1.5%, and the Nasdaq 100 is up 2%, which is normal, 400 points. What do I think is going to happen? Well, I think when the details actually come out at 7 a.m. from Besant, we'll see the markets sell off, and I personally think the markets are too optimistic, even though they haven't really risen that much. And it will be really interesting as well to hear what the Chinese have to say. I think that's important as well, what the Chinese have to say. Very important, actually, probably more important than what Besant and Trump are saying. It seems like they're just trying to maneuver the market. It just seems crazy that that's what's going on. So I said earlier that long-term treasuries are losing the war to gold. And yes, gold is down overnight quite substantially. We're down $53 right now at 32.71, 1.5%. Silver, though, is slightly higher, 32.83. I'm not concerned about gold, but let's look at this long-term chart of the price of gold in US 10-year notes. That's constant maturity 10-year note futures, or 10-year cash 10-year notes. What is constant maturity? Well, you always have to keep updating to the new 10-year, because when you issue a 10-year Treasury note, when the Treasury does issue, let's say in 2025, by 2027, it's not a 10-year note anymore, it's an 8-year note. So it has to be adjusted. So this is just like having the price of gold in 10-year notes instead of dollars. And dollars, don't forget, cash is really a debt security, but it's a spot treasury, right? If you think about it. So this isn't any different than cash. So it's not really surprising to me, but a lot of people don't look at these kinds of charts, and they still think that having bonds in your portfolio is a good thing. Or I'll give him a little bit of credit that it might be safe because the government will always pay you back. But I think that keeping 40% of your wealth in bonds doesn't really cut it in the current environment and for the future prospect of the system. I think I've seen someone talk about a new 40-20-20 portfolio, 40% stock, 20% bonds, 20% gold. That would be huge. We're not there yet, but I think sovereign wealth funds, central banks are showing the way. And that's why JP Morgan talked about the $6,000 gold by 2029. It could be before 2029. So as you can see, during this century, like against stocks, gold is outperformed, versus treasuries as well. Yes, after 2011, there was a big consolidation, just like the gold price did in cash, up until basically the beginning of last year when it actually took off. And you can see here that it's continued to go higher. So what this means is that yes, treasuries could rally in nominal terms, but in real terms versus gold, we've got a bull market in gold, a bear market in treasuries, and that's why the dollar is going to continue to weaken. And if treasury yields don't behave and go towards 5%, which is what Secretary Besant said is kind of a line in the sand, I expect the Fed to step in and do QE or yield curve control. But all that will do is going to put a rocket up the gold price. And I wouldn't be surprised if this chart would still be going a lot higher, even as Treasury prices go up versus the fiat dollar, right? So I think it's really important to keep an eye on this. I've spoken about this ratio before. I hadn't looked at it for a while, and I just thought it would be good to do a refresher. And it looks to me that unfortunately for Uncle Sam, investors are moving more and more away from U.S. Treasuries. But I expect U.S. officials to pass or come up with new rules and regulations to force and to allow banks and pension funds and other financial institutions to load up on more treasury. They're going to have to find buyers for all this debt because foreigners are moving away from it, as we've seen in spades now. There's all this talk about moving away from the dollar. And even if they have a pretty good trade deal, if with China, it's still, I think foreigners will still be very wary of trusting, unfortunately, the US administration. And what if in the next election there's a change? So it's all very messy. And I think, yeah, it's another nail in the coffin for the status of the dollar as the major reserve currency. So, yes, last night didn't do a live stream, mainly because, yeah, the works are still being done in the house. My study is like it's a mess, even though they've done a lot of work in there. And I was going to go upstairs to do the live stream, but the Wi-Fi doesn't work very well there. So yeah, we'll have to wait and see, and for when we're going to be able to do another live stream. Hopefully next Sunday. And with that, I'm going to wish you all a very good start to the week. Take care. Bye.